I'm not going to use my full 20 minutes here. So if you're expecting to make a decision tonight as to whether you should use a company or not, this isn't for you. This is just to give you a couple of ideas of the type of thought process you need to go through. So, basically, what did Rishi say? I think most people think the budget was pretty much a damp squib, to be honest. There really wasn't a great deal in there for most people. We all expected there was going to be a load of tax increases for pretty much everybody, and there wasn't really. There was increases for companies, and that was pretty much it. I know there was pay freezes, allowance freezes, that type of thing, but there was, in the sense of actual increases, there wasn't a great deal. The one thing that was in there was an increase in corporation tax rates, and we've now got 3 tax rates, depending on how you want to put this, but we've got the 19%, which is in at the moment. We've got a new top line rate of 25% on profits over a certain level. And what that actually means is there's now something called a marginal rate as well, which I'll not bore you with, but the rate on that marginal rate, which is actually the profits between 50 and 250, is now 26.5%. And I can, if anyone really cares how that's calculated, I can fill you in after, because I can assure you most people don't care how it's calculated. But what I think is worth looking here then is what the different rates are and how to get a simple feel for how this will pan out. Well, we've got a number of personal tax rates. Most of you will recognise these, but it's probably worth just clarifying. So on your personal allowance, you don't pay any tax. On income between your personal allowance and up to the 50 grand threshold, you pay 20% tax. That's the basic rate. Most people are aware of that. Once you hit 50 grand, you start to pay 40% tax. And there's actually a slight quirk. When you hit 100, you actually lose your personal allowance, which gives you this effective rate of 60% for a little bit. You then go back into 40. And once you hit 150 grand and above, you pay 45% tax. So if you're in the 45% plus band and you're a landlord, you've presumably taken some advice on this. Most people will either fall in the basic rate or the 40%. So for simplicity, I'm going to just look at those. If we can make some base assumptions here as well, then, so your first £50,000 of income is taxed either at 0% or 20%. The first £50,000 of profits in a company are taxed at 19%. That hasn't changed. What you've then got is you've got a band of income above that, which is then taxed at 26.5% in companies. And I'm just going to assume here we're comparing a higher rate taxpayer. So someone who earns more than 50 grand from other sources has some property. And I'm just going to assume that that property is over 50 grand in their company as well. Otherwise, I'll be on all day working on hundreds of scenarios. So everything you see here is basically just either a 40% individual taxpayer or the 26.5% corporate tax rate. It doesn't make a great deal of difference on the corporate side. It's not that big a shift in the rates. But it's worth just covering off a bunch of things here. And I'm hoping I can see Paul Hampton's head. Can you see my mouse cursor on the screen, Paul, or not? Just nod, yeah. Right. So first off, it's worth just stating here that if you're a basic rate taxpayer, you pay 20% tax on your rents. And if you're only ever going to be a basic rate taxpayer with rental income, you can all but forget the need for a company. The main purpose of looking to save tax to a company, I'll come on to, but it just simply doesn't apply to basic rate taxpayers. So in this example, though, I've got 150 grand gross rent, which might be, I don't know, 30 Tyneside flats, just to give you an idea of what this is. We're paying 50 grand out in interest on your mortgages. That would also include things like arrangement fees. So any finance charges could be in there. And let's just say we've got 25 grand of other stuff going on, tenant fine, advertising, repairs, maintenance, insurances, that kind of thing. So we've made £75,000 of cash here in this business. I'm going to assume it's a couple of people, it's a husband, wife, or two people sharing this income. And that for the basic rate, this is 2 people, their half leaves them at the 20% rate. They pay 20% tax on that. So 75 profit, take home 60, nice and simple. For higher rate people, the way it works is it's not just a flat 40%, because you don't get relief for all of the interest in the way you used to. you've actually got an effective rate for a 40% taxpayer. The effective rate on the rent here is 53%. So again, I'm happy to go through individual circumstances on a one-to-one, but what you've got here is you made 75, your take home is only 35. So what most people do is they say, well, I don't want to pay this 53% rate. I'll set up a company, because the company rate, even at its highest, is only 26.5. So on the face of it, you think, well, I'm saving money there. And if all you're doing is rolling that money up in the company, on an annual basis, this company would add to its reserves £55,000. If they took that money personally, there would be 20 grand less at the take home. That's not really the end of the story though, because that money's in the company, you can't spend it. If you want to spend it on a personal matter, you've got to take it out. And of course you pay tax on taking the money out. The net result is, if you're going to set up a company, run your properties through it, and then take all of the money out and spend it, then the take home after you've extracted it is only a couple of grand difference to had you just left it where it was anyway, on this example. So there's a lot of energy and hassle gone into that to not really be any better off, or not materially better off anyway. The reason people use companies is, if you're trying to save up your rent to buy more property, you would use that 55 there to save up towards your next thing, and 55s add up quicker than 35s, if that makes sense. So it allows you to then build up reserves towards your next deposit or something else that little bit quicker. And again, there's no comparison here for what if you're a basic rate, because you wouldn't do this. If you're a basic rate, you don't need to think about it. Now that's the income. What happens on capital though? Because at some point, someone is going to sell these properties. It might not be you, it might not be you anytime soon, but someone is going to sell these properties. So there's a couple of things worth bearing in mind here. We've saved, as an eventual saving, once it's in your personal pocket, probably a couple of grand on the portfolio here per year. That's all it is. It's a couple of grand. You've probably paid slightly higher costs of running the company anyway, so you could argue you're probably breaking even if the idea is to extract all of the money. And even if you said, well, I'm going to leave it in, you can't leave that 55 in forever, because what's the point in having the income if you're never going to use any of it? So the actual answer will be somewhere between the 55 and 37 take home. But let's just say you're saving a couple of grand a year. What happens when you sell these properties then? Now, I said this could be 30 Tyneside flats. You might sell them in 20 years' time. And in 20 years' time, each flat might give you £100,000 gain. If we have a good couple of years, we could all be sitting making this kind of gain on a Tyneside flat in 5 years' time, but I doubt it. But at some point, let's say there's 100 grand's worth of gain. Again, basic rate taxpayers pay 18% at the moment on residential gains. If we've got a couple here, they'll both be covered, assuming no other income, that would be covered. They pay 18%. Their take home on that 100 is 82. It's nice and simple. Higher rate taxpayer is 28% at the moment, probably going to go up, but at the moment, 28%. Nice and simple, their take home is 72. Again, it couldn't be simpler. I'm ignoring for this purpose the fact that individuals can make about 12.5 grand before they pay tax, but these rates would actually be slightly, better. You would pay a little bit less than this, but for simplicity, I've put that in there. Now, what happens in a company? And I think this is something that's often very much overlooked. So if you remember on this slide, we said we're saving a couple of grand on the portfolio. What happens when we sell each property? Well, again, we've made 100 grand in the company. The rate is 26.5%. So the company is left with 73 after it's paid its tax. It's not your money at this point. So if you want to buy a boat, buy the kids a house, pay something off, or I don't know, do whatever, you've got to get that money out. If you're a high rate taxpayer and you want to get that money out, you lose just under a third of that as your personal tax bill to get it out. And what we've got here then is on each property where we've made 100 grand, or to be more pessimistic, every time we sell 5 and make 100 grand, we've lost quite a bit of money here by the time you put it in your pocket. So you've lost, 20,000+ pound there. Now, if this was on every property and there's 30 properties, we're losing 30 lots of 20 grand here. But we were only saving a couple of grand a year. So you've got to make sure this is definitely the way you want to go. And I'm not saying you shouldn't, but you'll come onto the message later. So you might think, well, why would anyone be buying properties in a company at the moment? And it's arguably because of what is probably going to happen. So if you want to buy lots of properties and build up a big portfolio, and you're going to use lending to do it, you probably haven't really got any option. And I'll show you why on this slide. So I know Paul's on here, and he'll probably shout out at some point about his prediction on base rates, and then we'll record it and we'll pin him to that and beat him up if he's wrong. But let's just all agree, at some point, interest rates are going to go up. I don't care when or how for this purpose, but they will go up. Even if they by some staggering leap went down, they're going to go up again. Now, if you're paying, 2.5 over base, if base rate goes to 3.5, that will double the amount of interest you pay on your mortgage. So we were paying 50 grand interest. We're now paying 100 grand on this portfolio. The rent will have gone up, but for illustration, I'm going to keep it the same, and your other expenses are still there. So we're now only making £25,000. We were making 75, we're only making 25. Basic rate taxpayer loses 5 grand, take home is that. There's a quirk here in that if you're a higher rate taxpayer, the more interest you pay, the higher your effective rate of tax becomes. And the reason for this, again, I can illustrate this for anyone who really has to have more figures, catch me separately, but you've made 25 grand, but your tax bill is actually 30 grand. So a lot of people think I'm just mad when I say things like that, but your tax bill is higher than the amount of cash you actually made. So this higher rate taxpayer here would actually have to pay all of their profit plus 5 grand from their own other sources of cash to the Treasury, to HMRC. And this is why a lot of landlords think the tax system isn't very fair. It quite simply isn't. You're paying tax on money you never even had, and then you've got a supplement from other sources. Now, whether this happens in 3 years, 5 years, 10 years, who knows? But if you want 100 houses and you're going to use mortgages to get there, you've got to bear this in mind, which all of a sudden makes this company route seem much more attractive, because that same 25 grand of income washed through a company, even after you paid 2 bites of tax, would, if nothing else, give you some money in your hand. Not as good as if you're basic rate, but you never would be if you had 100 houses or you're making this kind of money. But at least you can then still have some money in your hand after you've paid your tax, which is kind of why I think if you really want to build up a very large portfolio and you're going to lend, I think the fact that interest rates will almost certainly go up is probably the only compelling reason why you'd have to go in a company, especially when you consider on each one of these houses, you might be losing 20, 30 grand's worth of capital taxes at the back end. I said I wouldn't go on too long. I'm not going to. That's pretty much that on the rents and how it works. I was speaking to a chap earlier about possibly you wanted to set up a company and buy property in. You've really got to think very carefully about doing this. And you know, if you're sitting there, you think, well, is that a yes or a no? Should I have a company or not? There is no yes or no answer. Quite simply, you can't answer this. It really is, it depends. And what we do to people is we get people who walk in every day and say, can you tell me how to do this? Should I have a company? Should I? And what they're trying to do is sort the mechanics out to get them on their journey without necessarily figuring out the right order of events here. So what we say to people is, well, look where you are now. You might be working with no property. You might be an existing landlord with 20 properties, but you want 20 more. It doesn't matter. We look at where you are now. We'll look at where you want to be. And that gives us the journey. And only then can you really decide how you're going to make that journey. So it's quite simple, but we get a lot of people who walk in and say, can I have a company because and they haven't necessarily looked at what the back end is. One thing's for sure is if you're planning capital growth as your main driver, and you definitely want to sell them and take all the money out, you've got to remember you're going to lose a lot on capital taxes. If you're planning to set a company up and leave it to your kids, grandkids, and never sell a property, that may change the answer. So it is important to set that. What else did he say then? As if that wasn't dry enough, what else have we got for you in the tax world? I think it was worth mentioning a couple of things here. CIHC is a close investment holding company, which most people have long forgot what these things are. But there are a lot of people out there with property investment companies, and there is actually a slight quirk in the tax legislation, which again hasn't been thought about for a long time now, because when the tax rates became unified for companies, it didn't matter. But the 19% rate for companies is only available to the extent that you're not what's called a CIHC. So when I'm talking here about these rates coming in over certain income levels in companies, they can actually apply to every penny of income if you are a CIHC. How would you become one? Well, an example is the revenue say you can have the 19% if you're wholly or mainly a non-CIHC. So you're actively trying to invest to make money, or you're trading, something like that. One of the catch-alls that brings you into the CIHC legislation is if you're letting a property to somebody that is connected to you. So a family member, someone connected to you, so your brother, sister, your mother, daughter, son, whatever. And if you are doing that, that counts as a non-qualifying use of a company for these purposes. To put this into simple numbers, if you've got 3 buy-to-lets and one of them is occupied by a family member, you would, for this purpose, be a CIHC, which means you will pay the 25% tax on all of your profits of that company. So it's more important than ever, if you've got a company, to be aware of what these rules are, because you can easily catch yourself out. And that's, 6% increase just by giving your brother somewhere to live. You might be better off not taking a 6% increase in your tax and not helping them out. I'm not suggesting you don't be charitable, but often you look for a good reason not to let a family member move into a house anyway. There's one for you. You can blame your accountant. What else is happening? Well, of course, there's all kinds going on with stamp duty, as we know. It's pulling the market all over, keeping people like Serby up at night and Paul up at night, trying to get them everything through conveyances and mortgages and everything. But there was separately a recent case. If you're buying things like flats above shops and you're buying both elements of it, there was a case recently where HMRC have changed the stance on the amount of SDLT you would pay on what's called a mixed purchase. There's different rates for commercial than residential, but a flat above a shop where you buy both is what's called mixed, and they've changed their views on this. It's worth going back to have a look at the rates you paid on that, because HMRC have basically said, yeah, we've changed our view. The way we now see it, the bill might be lower. Go back and have a look at that if you've done any mixed purchases. Finally, they also launched a whole bunch of consultations. The Office for Tax Simplification, I've mentioned there, OTS, they've basically got all kinds going on at the moment, but OTS, the Office for Tax Simplification, basically look at quirky, unusual, weird rules and try and abolish them. Unfortunately, a lot of the reliefs that people rely on are the quirky things. So often this can mean that a relief that you've relied on to reduce your tax is gone. So anything could come out of these. There's also been a lot of talk about inheritance tax, which is a huge issue for landlords. It's probably the single biggest tax that you'll pay when you account for probably losing 40% of your portfolio at the back end. There was a suggestion at some point that instead of having an a lifetime limit, one of the suggestions that seemed to get a bit of popularity was there would be an amount you could give away on an annual basis. It would be fairly modest. I say modest, it was about 30 grand a year. And quite simply, anything else above that would be liable to inheritance tax. If something like that came in, and you're sitting on a dozen properties, it would actually be really hard to use those reliefs in any meaningful way, which will invariably mean a significant increase. So it's always worth keeping an eye on inheritance tax as a landlord. They've also announced a review of trusts, which again, inheritance tax comes into trust use quite heavily. So that's worth looking at. And they've also got all kinds going on with green things at the moment. And there's a consultation on something called the Green Levy. And utility bills often seem to be somewhere where these things land. It'll be interesting to see whether they land on the person that pays the bill, or whether there's any kind of movement to try and shift that in some way to the property owner based on the EPC or something like that. I think our friend from North East Landlords dropped off now, but I know there was certainly talk a number of years back, Bruce will probably remember, there was talk about the water companies having the power to chase the landlord for unpaid bills, probably because 85% of the bills are from tenants. So just worth bearing in mind, there could be some interesting movement there. And I think the only other thing I've got to mention here is anybody who was at the first ever North East Landlord event, or even the old Robson Laidler property conferences, will remember that I used to talk about something called Making Tax Digital, which isn't a very exciting name because you've probably all been submitting your returns online now using HMRC's portal for a number of years. But this is a restatement of HMRC's plans that if you have, the working figure here is £10,000 worth of rental income, then instead of an annual return, you'll have to submit a quarterly tax return, much like VAT registered businesses submit a quarterly return. So the idea here is that from April 23, we'll probably all need to gear up and get ready for a quarterly income tax return. And the logic here is the working kind of view is you would do 3 of these quarters and then a balance and adjustment in the 4th quarter for anything that you didn't know about. And this would be a declaration of all things. If you're in the system, it's everything you've got. So yeah, just keep an eye on that and make sure you're ready. And for companies and VAT registered businesses, part of the rules here are that your records have to be available in what they call a 2-way digital system. So you can send information, but it has to be able to take queries from HMRC. Now, they haven't used that in any way, shape or form yet, but that was built into the original plans. So you probably won't be able to just dial into HMRC and type your figures in. The suggestion is that you will need some kind of electronic software, something like Xero, Free Agent, that type of thing. But on that exciting note, I think that was my last slide. So that's Martin out from Robson Laidler.